How will the Canadian housing market evolve in the face of economic shifts and policy changes? Welcome to the Multifamily Real Estate Insights podcast. I'm your host, Sandy McKay. Let's get right to it. According to RBC's latest housing market forecast update, Canada's housing market is experiencing a rocky year. A trade war has disrupted an early recovery in demand, driving transactions to cyclical lows this spring and pushing down property values, particularly in Ontario and British Columbia. RBC's January outlook had anticipated interest rate cuts would spur activity and push prices slightly higher in 2025. However, market conditions have been weaker than expected. RBC now projects home resales will decline by 3.5% in Canada to 467,100 units this year, with the first half seeing a 4.1% pullback, largely concentrated in Ontario and British Columbia. Encouragingly, recent signs of an ongoing recovery have emerged. Prospective buyers are re-entering the market as economic fears ease and lower interest rates gain traction. RBC expects this gradual recovery to continue in the second half of 2025, setting the stage for stronger demand in 2026. Looking ahead, RBC projects a 7.9% rebound in home resales next year, reaching 504,100 units. While this remains below the pre-pandemic five-year average of 511,000 units, several constraints will temper the recovery. A fragile labor market, reduced immigration targets, and affordability challenges will limit the pace of growth. In Ontario and British Columbia, where affordability issues are acute, supply-demand conditions have shifted in buyers' favor. The National Composite RPS Home Price Index is expected to rise by 0.7% in 2025, but this reflects gains made earlier in the year. RBC anticipates prices will decline in the latter half of 2025 and into 2026, with Ontario and British Columbia experiencing the steepest drops due to high inventory levels and strong competition among sellers. Regionally, prices will vary significantly. Balanced supply-demand conditions in the Prairies, Quebec, and parts of Atlantic Canada are expected to support modest price gains in 2025 and 2026. In contrast, Ontario and British Columbia will continue to face challenges, with imbalances in condo markets in Toronto and Vancouver likely spilling into other segments. The pandemic's impact on the housing market seems to have run its course. Exceptional circumstances, like rock-bottom interest rates and government income support, accelerated transactions that would have occurred later. The subsequent market slump triggered by rate hikes in 2022 largely corrected this unsustainable surge. RBC believes a growing number of Canadians are ready to re-enter the market under the right conditions, such as improved affordability, stable interest rates, and better job prospects. Brighter economic prospects are expected to lift confidence. The unpredictability of the trade war has weighed on buyer confidence this year, but recent developments suggest its impact will not be as widespread as initially feared. RBC expects Canada's economy to gain momentum in the second half of 2025 and accelerate further in 2026, gradually improving labor market conditions. The unemployment rate is projected to peak at 7.1% in late 2025 before easing next year. Interest rate cuts by the Bank of Canada since June 2024 have yet to fully play out. Although last fall's market recovery was interrupted by the trade war, RBC expects it will resume as lower borrowing costs trickle through the economy. Additional stimulus from rate cuts is unlikely, as RBC forecasts the Bank of Canada will hold its policy rate steady at 2.75% through 2026. Declining ownership costs driven by lower rates and moderating prices in some regions have made homeownership the most affordable it has been in 3 years. This trend is expected to continue, encouraging more buyers to act. However, significant affordability challenges persist, particularly in high-price markets like Ontario and British Columbia. Despite some relief, the share of household income required to cover ownership costs will remain well above pre-pandemic levels, limiting the pace of recovery. The federal government's substantial cuts to immigration targets will slow population growth and household formation, primarily affecting rental demand. Newcomers, who typically rent for 5 to 10 years after arriving, will account for much of this decline. This shift will also have knock-on effects in urban condo markets in Toronto and Vancouver, where investor demand is expected to remain subdued. A steady influx of sellers during the past 3 years, combined with weaker transactions, has pushed inventory in Ontario and British Columbia to decade highs. Buyers now have more options and feel less urgency to act. In contrast, inventory remains tight in the Prairies, Quebec, and Atlantic Canada, where listings are still below pre-pandemic levels. RBC expects supply and demand to gradually rebalance as sales pick up. However, it will take time for the market in Ontario and British Columbia to stabilize. Until then, strong competition among sellers will likely keep prices under pressure, with declines continuing into early 2026 before steadying. A new bylaw in Toronto aimed at curbing rent-evictions is already showing positive effects, according to tenant and anti-poverty advocates. The Rental Renovation License Bylaw, which was implemented on July 31st, requires landlords to obtain a license from the city before conducting renovations that necessitate tenant relocation. This measure is designed to protect tenants from bad faith evictions under the guise of necessary renovations, a tactic often used to bypass rent control and increase rental prices. Douglas Kwan, Director of Advocacy and Legal Services at the Advocacy Centre for Tenants Ontario, reported a noticeable decline in rent-eviction-related calls leading up to the bylaw's implementation. We're seeing far fewer calls regarding rent-evictions leading up to the implementation date of July 31st, so it's already had a positive impact in that sense, Kwan stated. He anticipates a gradual decline in the number of N13 notices or rent-eviction calls throughout the rest of the year. The issue of rent-evictions has been escalating in Toronto and across Ontario over the past decade, with a significant increase in the last 5 years. Alejandra Ruiz Vargas, president of Acorn Canada, highlighted that since 2017, there has been nearly a 50% increase in N13 notices filed in Toronto. I know a couple that has been rent-evicted 3 times last year, she mentioned, emphasizing the bylaw's implementation as a huge win for renters. This bylaw is seen as a beneficial measure not only for renters, but for the overall housing system in Toronto. It helps preserve affordable housing stock and offers a quicker solution than constructing new affordable housing. The bylaw includes strong requirements, such as the need for an architect or engineer to confirm that a unit must be vacant for renovations, and mandates rent gap payments if tenants have to move and pay higher rent elsewhere. While the bylaw does not apply retroactively to tenants who have already received N13 notices, it strengthens the fight against unjust evictions by placing the onus on landlords to prove that their renovations require vacant units. The City of Toronto plans to adopt an education-first approach to ensure compliance, with enforcement actions to follow as needed. Landlords could face fines up to $100,000 if they fail to comply with the new licensing requirements. There are concerns about the enforcement of this bylaw, particularly regarding smaller landlords who might be uneducated or willing to risk rent-evicting tenants. Chiara Paravani, co-chair of the York Southwestern Tenant Union, pointed out that some landlords might absorb fines as a cost of doing business to replace tenants with those willing to pay higher rents. However, the provincial government has doubled maximum fines for unlawful evictions, and it's crucial that the City of Toronto allocates resources for effective enforcement. Jeff Schlemmer, Executive Director of the Community Legal Clinic of York Region, stressed the importance of enforcement in making a real dent in unlawful evictions. You can make the penalty capital punishment, but if the person knows they're not going to get caught, they're still going to try it, which is what we have for rent-evictions, Schlemmer stated. He hopes that the City of Toronto will dedicate meaningful resources to enforcement to significantly reduce homelessness and illegal evictions. Let's delve into an intriguing development in the world of multifamily real estate and affordable housing, focusing on a recent initiative from Utah. As reported by Wesley Park, Utah's real estate market in 2025 is teetering on a supply-demand imbalance with a notable gap in affordable housing. The state is experiencing a housing crisis skewed heavily towards luxury properties, with homes priced under $300,000 accounting for less than 5% of sales. This has created a significant challenge for first-time buyers and lower-income households. To address this issue, Utah has launched a $35.5 million multifamily housing bond offering. This initiative is structured through special assessment districts and offers stable returns by leveraging developer fees. The bond is tied to the Westside Haines City project in Florida, but utilizes Utah-based legal and financial expertise. This strategic move not only addresses the affordable housing gap, but also presents a financial opportunity for institutional investors. The bond offering is part of a broader trend where states like Utah are leveraging infrastructure-backed financing to tackle housing affordability. These bonds are reimbursed through developer fees linked to infrastructure projects, creating a self-sustaining capital stack. For investors, this model offers stable cash flow and long-term capital appreciation as underserved markets absorb new housing stock. The strategic value of Utah's bond offering isn't limited to the state itself. It reflects a national shift towards Sunbelt states such as Florida, Georgia, and Texas, where population growth and regulatory flexibility drive innovation in infrastructure financing. This trend is particularly compelling in 2025 as rising interest rates push buyers towards rentals, increasing demand for multifamily housing, especially affordable units. Utah's multifamily market, for example, is projected to hit 92.4% occupancy by the end of the year, with rents rising by 2.5%. Bonds tied to such projects offer yields that outpace traditional municipal bonds while aligning with environmental, social, and governance criteria, a growing priority for institutional portfolios. For investors, the key takeaway is to prioritize bonds that combine mission-driven impact with financial rigor. Utah's offering, along with similar projects in the Sun Belt, achieves this by mitigating risk through reimbursement models, scaling yield by targeting high-growth submarkets, and leveraging tax advantages. Tax-exempt municipal bonds provide a hedge against inflation and rising rates, with yields often exceeding 4 to 5% in 2025. The Utah bond serves as a microcosm of a larger trend, the rise of infrastructure as an asset in Sunbelt states. Developers and landowners are increasingly using community redevelopment areas and neighborhood conservation areas to expedite bond approvals while minimizing veto risks from school districts. This approach attracts national builders and institutional capital, ensuring projects remain compliant and attractive to capital markets. In conclusion, the Utah $35.5 million bond offering is a blueprint for how affordable housing can be both a social and financial triumph. As housing supply constraints persist and Sunbelt states lead the charge in innovative financing, it's an opportune time to allocate capital to these mission-driven, yield-enhancing opportunities. It's a reminder that the best investments are those that build communities and portfolios simultaneously. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy McKay. See you on the next one.